And everybody said, how can they do this? How can FATCA exist? It's important to understand that. The Bank Secrecy Act was a law that was passed in the 1970s. And if you Wikipedia the Bank Secrecy Act, you'll see that the Bank Secrecy Act is a series of laws that kind of, expanded itself over the years. So the Bank Secrecy Act came into play in the 1970s really to combat situations involving mafia crime. The type of terrorism we were dealing with was more narcotics, arms dealings, things of that type of, activity that we were trying to deal with. We started seeing things like cash transaction reports, okay? We all know what a cash transaction report is because everybody knows that if you go and you buy something that's more than $10,000, the merchant, for example, would have to report that $10,000 payment to the IRS, or actually it was the Department of Treasury. If you withdrew money from a bank account, the bank would have a cash transaction reporting requirement. There were other requirements that banks would have called suspicious activity reports and things of that nature. Wire transfer information would be kept. There was an organization called OFAC, the Office of there was an Office of Foreign Asset Control. They would keep records of transactions that went between countries and financial transactions that occurred. And all of these things emanated from this Bank Secrecy Act. In 2001, we had September 11th. And at that point, the Bank Secrecy Act became even more important because it became a weapon to combat terrorism. And what the Patriot Act did was it expanded the government's right to look at our Fourth Amendment and Fifth Amendment freedoms, and it allowed the government to elevate the ability to look beyond really our borders and peer further into our bank accounts in a way that we've never seen before. Because prior to 2001, it was 2003 to be exact. In 2003, when the Patriot Act was extended into law permanently, in 2003, the Patriot Act was given to the IRS to handle. Prior to that point in time, there was a part of the Department of Treasury called the FinCEN group that was handling that. So it wasn't exactly handled by the IRS per se. And so when the Patriot Act was passed into law in 2003, extended permanently into the law, the IRS gained control of it. And what happened at that point was the IRS basically started to enforce this law of FR filing, which had been around for 20 or 30 years before, and actually began to enforce this law. So we saw the Patriot Act really being the force that started to view the accounts of others, our account holders' information, and it made those account holders' information being viewed and scrutinized very carefully. And we used that Patriot Act to start to examine things like account holders at UBS Bank. We issued summonses called John Doe summonses upon UBS Bank in 2007, thereabouts, and requested the names of account holders because we were interested, under the guise of terrorism, okay, at the beginning of this, to find out who was funneling money into this country because we wanted to find out what happened under September 11th in 2001. And as an aside to that, we also wanted to know who was hiding money overseas. So the Department of Justice issued these John Doe summonses, and they fought about this in the UBS case. They didn't want to give the information because bank secrecy at that time was a constitutional freedom and right in Switzerland. Okay, that's what they stood behind, the Swiss government, and they didn't want to give up that information. Eventually, because we had a treaty that had an exchange of information clause in it, they were able to, in the international courts, come to a resolution where the information was going to basically have to be given up. And that was what the impetus and why FATCA basically works and makes sense, because the treaties basically require, and most of our treaties have these exchange of information clauses, and the diplomatic treaties, it causes the information to have to be given up. And so that kind of gives the legal history of why FATCA works and why the information has to be given up. So everybody thinks that they can escape. They can't. FATCA's here. The banks now have very sophisticated systems where they are actually knowing their customers better. Their banking systems also are identifying things like there's indicia that will indicate whether or not somebody is a U.S. person. For example, if you gave the bank a .com address, they'll be able to identify it's a .com address, and they'll know that they should check to make sure that that account holder might be a U.S. person. They look for date of birth, or place of birth, excuse me. They look for passports, green cards, visas, different things like that, addresses, and things of that nature to determine whether or not the person holding an account might be a U.S. person. So those are the things that banks are also doing. You know, we talked a little bit about the Bank Secrecy Act, but the Bank Secrecy Act is basically there to figure out, you know, who is this person that we're dealing with. And it's to gain knowledge of the person that is transacting the business, and it's designed really for transparency. U.S. tax law. So the Bank Secrecy Act, by the way, is Title 31 of the U.S. Code. And that's the other part that I think is very confusing for accountants. Accountants really focus on Title 26 of the U.S. Code. It's totally a separate book, okay? So Title 31 of the U.S. Code deals with our Bank Secrecy Act. Title 26 of the code is our U.S. tax law. So the U.S. tax law focuses on how we're taxed, okay? A lot of people don't realize this, and this is where people also get kind of messed up in all of this. The United States is one of the very few countries that taxes based on worldwide income. And so basically what that means is, as a U.S. person, you're taxed, and what must show up in your tax return is every dollar that you earned, no matter where you earned it, okay? You might have something called a foreign tax credit that may offset the tax that you pay in the United States, but if you earned a dollar in any other part of the world, it has to show up in your U.S. tax return. That's how we tax in the United States. And a lot of people don't understand that. A lot of people think that, oh, if I earned some money in India, for example, and I paid tax on it in India, I don't have to worry about that in the United States tax return. If you don't include it in the United States tax return, you have a problem. So the issue that I often see in dealing with this problem is when you have that combination of not filing the tax return correctly, and on top of it, you have a Bank Secrecy Act violation of not filing an FBAR, that creates a real problem. So U.S. tax law, there's some really strange forms that accountants often miss when they have a person that has income in the United States and also income in a foreign country. And I just listed a few to show you that these are the forms that I routinely see that don't get included when somebody misses reporting their foreign earned income. One of the forms that's strange is called a PFIC, and a PFIC form is an 8621 form, and it is required whenever a person has a passive foreign investment company. Sounds like a nice fancy word, but basically what it is, it's a mutual fund. If you own a foreign mutual fund, you most likely own a PFIC. And what the PFIC law requires us to do is to basically force you to take a deemed dividend from that investment, even though you didn't sell it, okay? And it's a tricky calculation, and it's a difficult calculation to make, but you're forced to take income from an investment in a mutual fund that you might not have sold. And the problem comes in when somebody owns multiple PFICs, and it makes it makes a tax return very, very complicated to do. The 8938 form is a form that was introduced in 2011. It's a FATCA-based, it's called a shadow FBAR form. It's really a form that was introduced by FATCA. So now what this form does is it pulls the information that's actually on your FBAR form for your bank accounts and financial accounts and actually pulls that same information into your tax return. One of the forms that's been around for a long time, but it really didn't get filled out that much, is this form, the 3520. The 3520 form is filled out whenever you receive a foreign gift, or if you're receiving a foreign inheritance, or if you're a beneficiary of a trust, it's a foreign trust, and you're required to put down the assets that you have received from a foreign donor, for example. And there are significant penalties for failing to file this. The 5471 is another form, and the 8865. You can see that there's a lot of forms here. But basically, these are informational forms that show your ownership in a foreign company, for example, or a foreign partnership. And if you have an ownership interest, you're required to report on an informational basis this ownership interest and tell the United States government about that. And sometimes you might even be required to take a dividend from that entity, because there's a lot of what we call anti-deferral regimes that are embedded in the international sections of the Internal Revenue Code, which prevent you from basically putting money in a company and leaving it there to defer your income tax. So these forms actually, if you don't file them, have significant penalties associated with it as well. And a lot of accountants don't know about them, and a lot of, what I find, a lot of taxpayers and individuals don't know about them. And, you know, it's their duty to basically become informed about them because it's the law. So this is some of the stuff that we see when we're dealing with this problem. And when a client, for example, or a taxpayer comes to us and tells us that they're a foreign person that came to the United States, they're now living in the United States, and their tax returns were not prepared properly. And these are some of the things that we often uncover when they tell us that they have an undisclosed bank account. When you have an FBAR filing,